Hi everyone, welcome to a brand new episode. I'm Marcus and today we're looking at Salesforce, ticker symbol CRM. We'll cover the income statement, balance sheet, cash flow, key figures, our key feature, and the technical aspect of the stock. Should we be buying Salesforce? Well, let's take a look. So Salesforce is traded on New York Stock Exchange and are in the technology sector, and Salesforce is a global leader in customer relationship management technology that brings companies and their customers together in the digital age. And they offer technologies within blockchain, artificial intelligence, mobile and social, and much more. If we go down to the screen, we can see that their market capitalization coming in at $147 billion and the revenue is at $21.3 billion. PE ratio coming in at 277. That is way too high for me. So basically that is a no. Well, whenever we see a stock with a high PE ratio, that tells you that the market expectation of that stock is high, and therefore there are potential capital gains on those stocks because there's a lot of investors coming in and pushing the price even higher. But guys, this could be a trap because you might think, okay, there's a lot of expectations here. We might see a price increase. Well, with the current economic environment where we see central banks across the world increasing interest rates, we will see economic slowdown. So we are also seeing that the financial markets are taking a hit. So we're seeing across the board the stock price declining. So it could be a trap. There's a risk that you get burned here. But I know for a fact that the forward PE ratio is around 30.4. Basically, a forward PE ratio is an estimate of the price of earnings for the next 12 months, and that is around 30. So this is too high, so that is a no for me. Profit margin coming in at 1.8. That is just way too low for me, so that is a no. Price to sales ratio is at 5. That is a no. I like companies with a price to sales ratio of maximum 4. Having a 5, I understand it's not far from the threshold, but it's still higher than what I like to take a look at, so that is a no. Price to book value, I like that. That is within my range. But if we were to summarize, PE ratio is too high, price to sales ratio is too high, so the company is overvalued. And they don't pay out any dividends, so we need to consider this as a growth stock. And the return on equity coming in at 0.9, that is a no for me. Basically, return on equity tells you about a company's ability to create a return on their equity, and coming in at 0.9, no, I don't like that at all. And the return on assets, that is a no for me. So the stock is currently traded at $147 per share. If you go down to the moving average, we can see that we are below the 50-day, but also below the 200-day moving average. This is a strong indication that we might see the stock price decline. If we take a quick glance on the chart, we can see that we are moving in a negative trend channel. But we'll take a closer look at the technical aspect further down. But let's head over to the income statement. And what we are interested here is that the total revenue we see went from $10.4 billion in 2018 and grew to $28.2 billion in 2020. And these numbers have been improving year by year. That is a plus. I like it. Gross profit went from $7.8 billion, grew to $19.5 billion. And same trend here. We are increasing year by year. That is a plus. Now, net income went from 360 million and grew to 1.4 million. And we can see here a bit of fluctuation here, but overall trend is positive. I would like to see a more stable development. But let's head over to the balance sheet. What we're interested here is that the current assets versus the current liabilities. And we can see that there's a difference between the current assets and the current liabilities. Basically, if the company were to convert the current assets to cash, they're able to pay off their current liabilities, and that is a plus. But I would like to see a greater difference between those two. They will still be able to pay off the current liability and have some cash left, but that is not much. But they are far from being able to pay off the total liabilities, and that is negative. So the total liabilities went from $11.6 billion and grew to $37 billion, and these numbers have been increasing year by year. That is negative. And the outstanding shares went from 707 million shares up to 989, and these numbers have been increasing. That is negative. Basically, they are diluting their investors, and also seeing that the the debt is growing and also issuing more shares in order to bring in more capital, that is a red flag. So that is a no. Now let's head over to the cash flow. What we're interested in here is that the operating cash flow versus the capital expenditure. We see here it came in at $6 billion and the capital expenditure is $717 billion, making a difference of $5.2 billion. And that is a plus. I like it. Now we see that operating cash flow went from 2.7 up to 6, and these numbers have been increasing year by year. That is a plus. And capital expenditure from 534 being growing, fell off a bit. They didn't invest as much in 2021, but overall trend is positive. So the operating cash flow is improving year by year, and also they continue to invest in their business. That is amazing. I like it. Now let's head over to the key figures. And what we are seeing here is that earnings per share went from $0.5 per share up to $1.4 per share, and these numbers have been improving. A bit of fluctuation here, but overall trend is positive. Revenue per share went from $14.6 per share up to $28 per share, and these numbers have been improving year by year. That is a plus. Equity per share went from $14.6 per share up to $58.7, and these numbers have been improving year by year. That is a plus. They don't pay out any dividends. That is a shame because I like those recurring income. Gross margin went from 74 down to 69, and we can see it is ranging between 69 and 74%. And we need to compare this data across the industry and see how is Salesforce doing compared to the competitors. But I would like to see them become more and more efficient, start reducing the cost of goods sold. Operating margin from 4% up to 5.4%, a bit of fluctuation here, but overall the trend is positive. I would like to see a more stable development. I don't like fluctuation, because fluctuation means uncertainty, and uncertainty is not good for business. It's not good for us investors. So, and also having an operating margin of 5%, I would like to see them start becoming more and more efficient, start reducing their the operating cost. And let me see here. Profit margin went from 3.4% up to 5%. Same thing here. A lot of fluctuation. They need to become more stable, but the overall trend is positive. Return on equity went from 3.4% down to 2.4%. Same thing here. We are seeing a fluctuation, but overall trend is negative. Return on equity tells you about a company's ability to create return on their equity, about on the capital you're about to invest in them. Return on asset went from 1.6 down to 1.4, and same thing here, fluctuation, and here overall trend is negative. Solidity tells you about a company's financial strength for the long term. We can see we went from 47% up to 61%, and these numbers have been improving. We fell off a bit in 2022, but overall trend is positive. Balance sheet liquidity went from 6.4 down to 1.4. Basically, balance sheet liquidity, same things as solidity, but here it looks at the company's financial strength for the short term, and we can see that these numbers are dropping, even though it's a fluctuation. But overall trend is negative. Debt ratio went from 1.1 down to 0.6, and also same thing here, a bit of fluctuation, but we have seen these numbers drop, and that is positive. Basically what is happening here is that in 2022, when they had 0.6, that means they had 0.6 times more debt than equity, and seeing that these numbers are dropping, that is positive. Guys, we have gone through the income statement, balance sheet, cash flow, key figures. Now over to our key features, which is the stock analyzer. And what it does is that it gives you a simplified, holistic overview of the company's performance, and it saves you a lot of time. If you want to dig through the numbers, you can dig through the numbers or have the software do the heavy lifting for you. If we look at the screen, we can see right away that the PE ratio is above 20, which is negative. They don't pay out any dividends, and the number of outstanding shares have grown. That is negative. Revenue increased over the past 5 years. That is positive. Profit margin below 15%, negative. Profit decreased over the past 5 years, negative. Current assets are greater than current liabilities. That is positive. And solidity have improved. That is positive. But the balance sheet liquidity have decreased. That is negative. And the debt equity ratio have improved. That is positive. And the total liabilities have been grown over the past 5 years. That is negative. Guys, As you can tell, it gives you a simplified, holistic overview of the company's performance, and it saves you a lot of time. You can have this software along with everything we've gone through, plus access to our discussion forum where you'll be able to chat with me along with other members for only $10 per month. So make sure to head over to commerce.sc and become a member today, okay? And support the channel. But now let's take a look at the technical aspect of the stock. So here we have the chart. As you guys can tell, we have been moving within a positive trend line for quite some time, and we have seen higher levels, but as of lately seen a significant drop in the stock market, and we are seeing that the stock price is continued down towards the support line here. I believe there will be a lot of investor taking hold on this, taking a stand, and potentially being adding more to this to the shares, to the stock here, to the portfolio here. But at the same time, with everything that goes on in the economy right now, we might see the stock price stagnate here for quite some time. But I believe as we go on, because we are anticipating, we are expecting to see a continued increase of the interest rates from the central banks from across the world, across the board. So we will see further down an economic slowdown, and that having Salesforce being a company that doesn't pay out any dividends, because I believe most investors, as myself, will go back to the fundamentals, be looking at valuation. Valuation is key, but the financials is everything. So I believe people will go back to investing in large and stable companies that are able to provide profits, can give out dividends, and also have the means to sustain uncertainties, because I believe those are the winners in this economic environment. So having Salesforce and other companies that doesn't pay out any dividend, those are the companies with the most risk of losing investors and seeing a withdrawal of capital. So Salesforce, I believe, sure, it looks like a potential buy right now because we are moving close to a key area, the support line. But I believe with everything that goes on, investors and the scarcity, and I believe people are looking for safety and hideout, and the hideout will be investing in safe and stable companies. Back to the fundamentals. So I believe going on, we might see a lot of buyers coming in around the support line, but for the long term, because we are anticipating, so the Federal Reserve doesn't know how long this will be going on, trying to combat inflation, and we are seeing some even estimates a percentage of 4.5 that could bring pain to the economy and bring down the labor market, and also bring down the inflation. But we don't know how long this will proceed. So for the long term, I'm not buying any growth stock. I'm more of stable dividend producing stocks, and therefore I believe most investors will be headed that way. So I'm not buying. Will you be buying? What's your thoughts on the Salesforce and the overall economy? Please let me know in the comment sections below, and I hope you enjoyed this episode. And please give me a thumbs up, comment, subscribe. And guys, we are not far from reaching 300 subscribers, so let's make that happen. I hope you enjoyed this episode, and guys, until next time, take care. Bye bye.